Well, here we are. Good afternoon. This is Professor Milligan, and I want to welcome you to my first live Instagram live cast that I'm going to explain to you and talk to you guys about the market, making money in the market, how to handle the stock market, derivatives, currency, pretty much how to trade them, how to make money. And so we're going to go through that in a lot of discussion. I also got a couple of questions that were asked of me today, so I'm going to go through a lot of things. So first and foremost, let me give you a little background. Again, my name is Michael Milligan. I go by Professor Milligan, Mike Milligan. Students call me Milligan. I went to work on Wall Street. I literally got licensed, showing my age, October 1987, before the great '87 crash. And I've been involved in the markets ever since. Pretty much you name it, I've traded. I've traded bonds, stocks, derivatives, currency. When I say derivatives, futures, Forex. The only thing I haven't traded, which you guys will probably ask me about, is Bitcoin, those Bitcoin and that type of currency, and I haven't traded those. So I'll talk about that a little later on, but I have not traded those. I have a hard time trading something I just don't understand, and I don't understand how Bitcoin works. Again, I understand how to trade based on technical analysis, and when I was younger, I probably would have traded Bitcoin based on technicals alone. But as I've gotten older, I use technicals and fundamentals. And one of the things I've learned is a confused mind always says no. So when you guys are confused or I'm confused, you're going to say no or shut down. So if you're confused, you shouldn't trade it. All right, so what else can I tell you? So I traded all that. Leased a seat on the Pacific Stock Exchange. I did that. I had an office at 111 Broadway, which was right across the street from the New York Stock Exchange, where I had my hedge fund. Worked for Lehman Brothers, Bear Stearns. I'm that guy. I've been involved in it. So that's what I'm here to share with you guys. Now, what am I sharing with you guys? I'm here to share whatever it takes to help you guys become successful in investing in this marketplace. Most of the guys on this call are millenniums. My goal is to help you millenniums to figure this thing out, to navigate these waters, and put up double-digit, triple-digit returns. I'm sorry, millennials. Again, I'm excited. My daughter corrected me, millennials. Not millenniums. So I do apologize for that. Okay, so you got that. That's my background. So let me start off with a couple of things. One, in order for you to become a very successful investor, the first and foremost thing is you got to figure out who you are. Are you a short-term investor looking for short-term profits? Are you a trader? Are you a long-term investor? What is your goal in investing? Are you here to make money? If so, put a dollar amount on it. Just don't say I'm here to make money. Let's be more specific. How much are you here to make? Am I here to help you make $100,000? Am I here to help you make $1 million? What is it that you need from me? But before I can help you, you got to tell me who you are. Are you conservative? Are you aggressive? How would you feel if you lost all your money? Would you just go into a panic mode and freak out if you lost every dime you ever invested? If so, then you're conservative. You shouldn't be doing speculative things. Then the next question is, what is your ultimate goal? What are you raising cash for? Is it to build wealth for you and your family? Are you saving? Are you investing to have enough money to buy a home, buy a car? These are things that you need to go through and understand, because the markets are going to be here. The markets are here for us to make money. The derivatives are here for us to make money. All these securities are going to work for us to make money. The question is, what is it that you want from this? So I hit on a couple of things. One, are you conservative or aggressive? That's the first thing you got to ask yourself. What are you willing to do to actually get to those goals? Now, when it comes to investing in stocks, are you a value investor? Now, a value investor looks to buy assets at a discount on the dollar. So if I think this house is worth $100,000, I'm a value investor. I'm going to pay 60, 70 grand for that house, no more. I'm going to buy that asset at a discount, because my belief is by buying that at a discount, if I hold it long enough, eventually that value will be realized by the rest of the marketplace. When you hear value investors and you hear what I'm saying, think about Warren Buffett. Warren Buffett will tell you he buys a company, He never plans on selling it. He is going to hold it. But again, when he does buy it, he's buying a business that he feels he's buying it at a 30-40% discount to its value. That's a value investor. Now, the second thing is, if you are a growth investor, that means you're willing to pay $100,000 for that house that was valued at $100,000. Your belief is a year from now, because of the growth in inflation, the growth in the marketplace, that house, let's say it's inflation at 3%, a year from now, that house is going to be worth $103,000. 2 years from now, the house is going to be worth a little over $106,000. A growth investor buys a company at a fair price, but they look for the future revenue growth, the future earnings growth, the future growth in the company to drive the value of the stock. Example of a growth investment, if you owned Apple, Amazon, Google, Facebook, those are all growth investments. You brought them at a fair price, hoping that, I said the word here, hoping that the growth in the company, the signing up of new clients, new products, new services, the growth in the value of the company is going to drive the value of the stock. All right, there is no right or wrong. It's really what's more comfortable for you. The one thing I'll add though, if you're a value investor, you need to start looking at buying stocks or assets when they're out of favor. The reason why they're typically of value is because they've fallen out of favor. Something's happened in the industry or the marketplace that has made this asset less valuable in the eyes of investors. One of the things I talk about in 2008, the Great Recession. I posted this on Instagram. Apple set a record. Apple set a record for the amount of revenue that they generated in the middle of that Great Recession. So companies can still grow even in a recession. Now, Apple stock did not grow with it. Apple turned out to be a value play during that because they were growing internally. The company was setting revenue records, growing, but the stock price was being held down by the marketplace. As soon as we came out of that recession, that stock took off. All right. So that's just a little bit of background there to help you guys figure out who you are, what you are, short-term investor, long-term investor. I'm here to help you with all of it. All right. Now, I did have a couple of questions I want to address real quick. One question was, when do you take profits? So I should add to this, some of you people on this call, so let me explain who's on this call right now that I know of. I see a bunch of my former students. Thank you for showing up. I see family members and friends, and I see a whole bunch of millennials. Okay, I got that. So I want to thank you guys for coming. Some of you guys are beginners. This is your first time ever talking about investing. Some of you guys are new to this. Some of you guys have been around. So hopefully I'm going to cover everything. For those newer people, please listen closely. For those who are vets, feel free to chime in. Those of you who I've worked with before, and make sure that you post your questions and send me your questions. So that's what I wanted to say. Now, the other thing I'm going to add before I go into this question is I'm going to save this recording. I'm going to record this, and I'm going to post this onto my channel on YouTube. So I have a YouTube channel called Professor Milligan. I'm going to post all these videos up there. I'm also going to create some videos to try and help you guys along with questions. I'll post that up there also. So, again, one of the questions I got was, when do you take profits? So those who've been around me know that one of the ways that you determine when you take profits is, and the first thing to say is, why'd you buy the stock in the first place? So if you have a entrance strategy, if you have a strategy on why you bought the stock in the first place, that will help you with the exit strategy on when to get out of the stock. So one of the Milliganism is, you'll hear me say it, and I say it a lot, and I say it all the time. I do not sell up stocks. If a stock's working, if the stock's going in the right direction, I am not going to sell it. So get that notion out of your head of buy low and sell high. All right? You're going to buy a stock wherever you buy it at, and we're going to sell it at a higher price than what we paid for it. And if it's working for us. If it's not working for us, we're going to sell it quickly. All right? But again, let your winners run. Now, when I enter into a stock position, when I buy a stock, there are two numbers already in my head. I'm going to give you an example. If I buy a stock at 10, I can already tell you right now, if I buy a stock at 10, if that stock hits $9, I'm selling it. I use a 10% stop on everything I buy, minimum. I am not going to take big losses. So if I buy a stock at 10, the two prices in my head are, one is to the downside. In this case, it'd be $9, a 10% stop, a 10% loss. And most likely, knowing me, if I'm buying a stock at 10, I think I'm going to see at least $12 to $13, which is a 20% on the upside. So in my head, I got two numbers in my head, 9 and 12. Which, if the stock hits 9 before it hits 12, I'm selling it at 9. If it goes to 12, I'm going to reevaluate my numbers. I'm probably going to now use a $10 price that if it goes to $10, I'm out. And I probably have an upside now to 15. So the two numbers in my head now are 15 and 10. If the stock goes to 15, I'm probably going to raise that up from 10 to 12 and then let it sit there for a while and let the stock run. But again, I do not take losses more than 10%. So that's my exit strategy. The other thing is, if I brought that stock because of some type of event I was looking for, some type of earnings announcement, some type of new product development, if I brought the stock because I thought this new product was going to be a catalyst to drive the value in the company, I'm watching that catalyst. And if that catalyst doesn't materialize, that's the reason why I brought it. It didn't work. That's the reason why I'm selling it. If it did work, I'm going to hold it. So one of the things that I want you guys to realize is big winners take time. They don't happen overnight. So if you're in a stock that is a winner, don't sell your winners. All right? It's not going to happen overnight. And when these things start to run, there's going to be natural pauses. There's going to be natural pullbacks. For those who are into technical analysis, you know I'm talking about the Fibonacci's and the natural pullback that we see, the retracement. So give the stock time to work for you. All right? I've never, ever knowingly sold a stock at its all-time high. If it happened to be at its all-time high, it was more luck than anything else. Again, I don't believe that no one can pick tops or bottoms. So again, I hope I'm answering the question. My strategy when I buy stock is I have two numbers, one to the downside, one to the upside. If it hits that downside number, I'm gone. The key to this whole thing is, and students have heard me say this, the most important asset you have right now is your capital, is your money. And I can't afford to lose all my money on one bad trade because it means I'm going to miss the good ones at work. So again, two numbers, one to the downside, one to the upside. If it hits that downside number, which is 10% below what you paid for it, I'm out. I buy stock at 100. I got a $90 stop on it. I got a $90 either physical stop or mental stop, but the stock hits 90, I'm gone. All right. Check my time as I look at the next question was concerning someone with a 401k. So here's what I'm going to say to you about 401k. One is, you guys, 401k is your retirement program through your employer. A 401k is a tax deferred, which means that you're not paying any tax on any of the interest or principal or any gains in that account. But once you retire or start to take money out of that account, they're going to start to tax you on it. The whole premise behind this is it's a retirement account, and once you go to retire, you'll be older, you'll be in a lower tax bracket, and therefore you should pay less in tax. But the money should grow a lot faster because you're not paying Uncle Sam as the money grows. Now, with a 401k, you can if you leave that company and go to another job, you can transfer your 401k into an IRA. Moving the money into an IRA will mean that there'll be no tax consequences, but again, the money's still there and you can, for your retirement, and you can still grow. You can also take money out of your 401k anytime you want. Check with your accountant because there are tax consequences. One is there's a 10% penalty unless it's a hardship case. Now, I don't want to get into all the hardship cases. There's a 10% penalty. But you can take money out. And if you take money out based on a hardship, there is no 10% penalty. But again, you take money out, penalty, and you have to pay taxes on whatever you take out. The other part of that question was about, God, I got to get this right. I guess about 5 or 6 years ago, Wall Street said that real estate now was another asset class. So we went from stocks and bonds and derivatives, we've added real estate as an asset class. One of those investments that are out there for real estate, people that want to invest in real estate but not actively buy it and manage it themselves, is what they call a real estate investment trust, which is also known as a REIT. A REIT will invest in real estate, some form of real estate. It could be raw land, it could be shopping malls, it could be apartment buildings, it could be mortgages. It must be related to real estate that they invest in. Like any investment, if you're investing in a REIT, a couple things to look at. One, who's managing the REIT? Two, what real estate are they buying? Are they buying raw land? Are they buying apartment buildings? And then again, you got to do your homework and see, going forward, where do I think the growth is going to be in real estate? Some areas of real estate grow faster than others. As we all know, raw land is more risky than buildings because you have to actually do more developing, and raw land doesn't generate any revenue. All right. Apartment buildings generate revenue. They have a cash flow. So again, this all has to be analyzed. I know on this call, I have a couple of my former students now who are actively involved in real estate investments in terms of analyzing. And also I know 2 or 3 of them now are actually doing real estate acquisition. In fact, one of them I was on the phone with yesterday told me that one of the fastest growing markets is the one he's in, is in Phoenix, Arizona. So it's pretty interesting. All right. Let me see. I do have another question. My last question I got so far, and this one was concerning books. You guys should read everything you can get your hands on. You must become avid readers. Some of it will make sense. Some of it won't make sense. Some of it will be good. Some of it won't be good. But one of the things is we're in the game right now. And the game is putting money in your pocket, making money in the financial markets. The more you know the rules of the game, the better it's going to be for you to win the game. And by reading these books, you're going to start to learn the rules of the game. And you can ask me questions. I've read books. I've been an avid reader in the financial markets since the day I got into the financial markets back in 1987, showing my age. Still avid reader. Some of it will make sense. Some of it won't make sense. Some of it you'll say this is a crock. Some of it you'll say, wow, I've learned a lot. There are books I read 20, 30 years ago that didn't make sense then that make sense now. So again, if you can, become an avid reader. I know over the years I've given students a list of books that I thought they should read, the books that I thought would be beneficial for them. So I'll see if I can find that list, and maybe I'll post it on my YouTube page or post it somewhere where you guys can find it. And feel free. I know students all the time recommend books to me. And before I get off of this, one other thing. A student showed me that on Google Drive, that they're giving away a whole bunch of free books on investing, trading, investing, technical analysis, fundamental analysis. There was a slew of them. I went through and looked. They're all free. So if you have an interest in that, Google Drive has some free books on investing. You should read the free books. All right. Now, I'm checking my time again. Okay, we got some minutes. I had a question come through about the financial markets right now and what's going on. So let me give you my opinion of what's going on. Take that, and I'm not sure what it's worth, but I'll give you my opinion. And a couple things. For the last 12 to 18 months, I've been getting emails and calls from my former students saying, Professor Milligan, we got an inverted yield curve. Now, some of you have no idea what I'm talking about with the inverted yield curve. I will teach it to you as we go over time. But one of the things about inverted yield curve is, in my lifetime, in your lifetime, every inverted yield curve we've ever had has led to a recession. So about 12 months ago, 18 months ago, we became inverted. Students started hitting me up, Professor Milligan, we're inverted. And I said, yep, we're inverted. And what that means is we have other economic signs, but I think we're going into recession, and that's just the nature of what the inverted yield curve tells us. So with that said, yes, one is, not only do I think we're in a recession, I think that we're battling and fighting to stay out of a depression. So I think that's where we're at right now. This is one of the few times in my lifetime. In fact, I did some research on this. Over the last 100 years, there's only been 3 times that we've actually been in a recession where the stock market did not go down or go into a bear market. It looks like that we might have one of those right now. The stock market and our economy are 2 distinctly different animals. Our economy right now is in a recession. Whether you want to hear it or not, we're in a recession. 30 million unemployed. Every major corporation that has announced their quarterly earnings and revenue said that they can't tell you what's going to happen going forward because of this coronavirus. So I guess the best way to put it is buckle up, guys. I think we're in for a bumpy ride. I also think that because of the nature of what's happening is that even when we open back up, even when that happens, we're not going to go back to the levels in terms of revenue and income on these corporations that we were seeing prior to this coronavirus. There's no way that can possibly happen with the number of Americans out of work, the number of Americans not traveling, the number of Americans that aren't doing certain things. These corporations are going to take a hit. The question now becomes, how long is that hit going to be? So you asked me, if that's the case, Professor Milligan, what's making the stock market run? What's making the stock market run right now is the fact that I got to say it. These politicians are pushing this market to hold it up and keep it up. They're pushing it to hold it and keep it up because we vote based upon our pocketbooks and our wallets. And right now, no one's happy with their pocketbook or wallet. So again, what you're seeing now is the politicians trying to push this market back up to levels and fight off this recession, at least until after the election. That's what the goal is. But my point is, there is a separation between the economy and the market. So with that said, I do think that after the election is over, if not sooner, I'd be real nervous about this market. So if you're a short-term trader, take your profits quickly. Don't look for much in terms of don't be greedy. Take your profits, hedge your positions. How are they pushing it up? Well, it's easy. The way that they're pushing this market up is that the Fed is doing everything they can to pump as much capital into corporate America. I read an article yesterday where they talked about the number of corporations, they call them ghost corporations that are taking money from the U.S. government to stay afloat, that know that once this coronavirus is over, they will not stay afloat. They're not generating enough revenue or cash flow to service their debt. And if they have to cut back in terms of their customer base from 100% to 50% to 25%, depending on what their business is, there's no way they can generate enough cash flow to service the debt, which means if you can't service your debt, you're going into bankruptcy. The Fed is pushing and pumping money into the system. The other thing they're doing is all of these bailouts to these corporations, and these corporations are accepting the bailout money, knowing that some of them aren't going to make the turn. So, the Fed and the U.S. government is doing everything they can to keep the market open, keep the market up. And again, it's all based upon, I'm not sure what it is. The other thing I look at too is, and you guys should look at this too, is when the market has these up days, a couple things you should look at when the market, on up days, one, how much volume was in the market? On a really big breakout, a really big move to the upside, you're going to see heavy volume on the buy side. You're going to see heavy volume. And if you see heavy volume, that means institutions are involved and they're pushing the market higher. On low volume, if the market goes higher on low volume, I always call that fool's gold. The reason why I call it fool's gold, the market's high and everyone's like, wow, the market's high, but it's being pushed off of small volume, low volume, which means that the institutions aren't really behind this. Today's run was really even more interesting, and that is that the market leaders, the companies that have been pushing and moving this market, they didn't push the market. They're pushing the market in other areas now. The other thing I look at when it comes to the market is how many stocks on a daily basis are setting new highs and how many are setting new lows. In a bullish market, you're going to find more companies setting new highs than new lows on a regular basis. I mean, you guys, it's kind of common sense. In a bear market, you're going to find more companies setting new lows than new highs. So one of the things I look at. Now you marry that company setting new highs with the volume in the market. So if I have companies setting new highs with light volume in the market, again, I'm not interested in that. Now I'm leery. Okay, so we covered that. Bear with me a second. I'm just thinking out loud. Any other question? Oh, I know another question that came up, and I got 5 minutes. I'm again, just a real reminder, guys. One, I'm recording this. I'm going to put it on my YouTube channel. So if you go to YouTube, I'm going to have a channel. I have a channel set up. I just don't have anything in there yet. Professor Milligan. I'll put that up there. I'm also going to post videos of other things, lectures I give to help you guys understand this. Now, a number of my daughter's friends and her are asking me about these currency trading. I'm not sure what they actually call it, but when you get these recommendations of what currencies to buy, and you know, Forex, currencies is Forex. You get these recommendations of what currency or what Forex to buy or trade. They're investing in these groups. I have nothing against the groups whatsoever. Here's my thing to you guys. You should have an understanding of what it is you're buying and why you're buying it. If you don't understand what it is and why you're buying it, then you become the victim of whatever somebody's telling you think is the best way to do it. You must figure this out for yourself. And that's what I'm here for. You know, I'm not getting spiritual on you, but I'm not here to feed you. I'm here to teach you how to fish. So, whether it's a stock, a bond, a commodity, or a currency, a Forex, you must learn how to invest before you worry about the asset class. If you're a horrible stock picker, then using derivatives to buy stocks is not going to make your performance any better. If you're terrible at picking currencies, then and have no idea what you're doing, you're at the mercy of the person giving the recommendations. So I'm doing my best now, and I'm going to do my best to teach you this. So when it comes to trading currencies, I use both a fundamental and a technical analysis to trade currencies. We don't have time for me to go into it now. I will. For those of you who are involved in these clubs and you're getting recommendations, you have to do a little more homework. Just don't take the recommendation and do what you're going to do with it, but understand what the recommendation is based upon. How was that recommendation made? What did they use for that recommendation? How do they determine if that recommendation is successful or not successful? You need to understand. And the third thing is, not all strategies work in every market environment. So right now, I'm not nearly as active in this environment because I'm getting mixed signals. I'm getting one signal on the fundamental side that we should be headed down and test the new lows. But when I watch the market, I see the market setting new highs. Or not setting new highs, but going higher. So I'm going back and forth between the two. I do have a couple of short-term trades to the upside I'm looking to make. I'm watching. I had several trades I made to the downside. So all I'm saying to you is that you must have a better understanding of the fundamental and technical analysis of what's going on with these trades if you're ever going to do these trades on your own. Now I'm going to toot my horn a little bit. And what I'm going to say to you is this. Some of my advanced strategies look for volatility. Let me say it again. Some of my advanced strategies look for volatilities. I know I have some people on this call that I'm seeing their names that know what I'm talking about, and I'm going to say this. I have personally done and have trained students and taught students to make, I'm studying because I'm excited, to make money what I call multiples. So multiple is you invest $1,000, a year from now, that $1,000 is worth $3,000, $4,000, $5,000, $6,000, $7,000, $10,000. All right, that's thinking in multiples. A lot of you have heard Wall Street say, no, if you get better than a 20% return on your money, you should be really happy with that and you're doing really good. Again, if you're a really conservative investor, that's a great number. For me, I always looked at how much reward am I going to get for taking the risk of going into the marketplace. And I structured my trading strategies, and believe me, this has not happened over a week or a month. This is years of me investing, years of me trading in the markets, years and years. And one of the things I'm going to say is that, I'm smiling again. One of the things I'm going to say to you is that making multiples on your money is possible. Now, one of the reasons why I say that is I'm looking at one of the text messages on this from one of my former students. I nicknamed him Ham, and Ham just told up there AYX. He made multiples on his way AYX investment. Also that, I'm laughing now because I also told Ham he was going to lose money on his option trade with the VIX. And he looked at me and said, no, I'm not, Professor. And a couple of weeks later, he looked at me and said, yeah, you're right, Professor. I'm like, yeah. So I'm going to teach you all this. And the reason why he lost money on that trade was, it wasn't because it was a bad trade. It was because the information that was given to him was the wrong information. So again, education's the key. And look, we don't want to talk about that. Yeah, I know you don't want to talk about it. You're still one of my favorite students, Ham, but I'm talking about it. And what you'll also notice is that for every one of my students, I have a nickname. All right. Now, I need your feedback. A couple things. One is, we've been on for a half hour. So I set this up for a half-hour call, so I'm about to finish this. If you guys think I can go an hour, I should go an hour, hit me up, let me know. The other thing I'm going to say again is, you can follow me on Instagram. I do have a ProfessorMilligan Twitter account. I also am in the process of establishing a ProfessorMilligan Facebook page. It's just me. The problem is me learning how to work a Facebook page. And I'm being honest. And I also have, as I said, a YouTube account. I have a YouTube account under Professor Milligan where I'm going to post all this. And one of my friends said, when Goldman buys, I buy. When Goldman sells, I sell. All right, I got to tell you my Goldman Sachs story. Then I'm going to let you go. And you guys know I always have stories. Several years back, one of the legendary Goldman Sachs traders was quoted in the newspaper. They wrote a whole article on him. He at the time was the most successful trader Goldman Sachs ever had. And at the time, he had set some type of record for the amount of money he made on one trade. And what he did was, he purchased a utility company over in the Far East. So I'm going to say a couple of things to you, because in the article written by the Wall Street Journal, they said, they should use him for case studies so people can actually learn how to invest. It's just great what he did. In the article he wrote, what was written about him said, it took him 2 years to put that trade on. He couldn't put it on. He saw it, but it took him 2 years. And the reason why it took him 2 years to put that trade on was he could not find a way to hedge that investment. Hedging is nothing more than transferring the risk. So in other words, this is a Goldman Sachs trader, the most successful trader in the world for Goldman Sachs history. They're writing articles about him, and he's telling you that before he could go into this trade, he had to figure out how to hedge it, how to reduce his risk. I can't emphasize enough for you newer investors and for you seasoned investors, hedging is key, especially when you want to take on bigger positions, especially when you're going for larger returns. You must figure out ways to reduce, mitigate, hedge your risk. Long story short, he said it took him 2 years to figure out how to hedge the trade. He said he finally figured out how to hedge it. He hedged it, put it on, and it was one of the most profitable trades he's ever done. So I'm going to leave you on that note, and that is, if you don't know what hedging is, keep following me, ask me questions, I'll teach it to you. I hedge everything the best I can. My whole strategy, some of my key strategies are hedging. So we'll get into this in a little more detail. Again, I want to thank everybody for coming and joining. And I want to thank my veterans who are showing up, the guys who I've known for years, who are also investors. Keep typing your little comments and the fact of the things that I talk about, how you've experienced it yourself and how we kind of work through it, or you work through it. I have no problem with that. The goal here is that everyone that's on this call, my goal is that you guys all make 6 figures in your portfolio, 7 figures. That's my goal. I want to hear you guys talk about the triple-digit returns you got. That's what my goal is. So with that said, I'm about to end this. I'll see you guys next Wednesday. Feel free to hit me up with any questions or any issues or any concerns. And again, I'm going to bring guests on. I'm looking now, I see one of my former students, Tommy, who made a ton of money trading the VIX based on some strategies that we have, and I'll share it with you. So again, thanks again. Have a great, great day, and I'll see you next Wednesday. Goodbye. Oh, hold on a second.
Sorry if you guys heard me in the background. I'm in and out.